Buenos días con todos. Good morning. Have a short number of attendees today, is probably because of coming midterms. Um, so let me just give a few seconds for everybody else to join. I just uploaded two files onto our, what is this, a Blackboard. And I'm trying to look for the name, la página de contenido de Blackboard. Blackboard Learn, that was the name I was looking for. So those two files are the ones we're going to be working out today, especially the financing. So last week, we managed to discuss how to figure out the elements for working capital, right? In particular, we discussed everything related to accounts receivable, accounts payable, inventory, and come up with some way to try to estimate them using our typical working capital ratios, right? Days of receivable, days of inventory, days of accounts payable. There were some questions after the class regarding if it was possible to use or calculate these ratios not using cost of goods sold but using revenues, right? So inventory divided by revenues times divided by 365, right, to come up with an estimate of days and so on, right? To try to figure it out with one single base. So I just wanted to put it out that that is possible, right? There are ratios that are calculated that way. It's not the most accurate way because you do understand that inventory and accounts payable are more related to cost of goods sold. But for some practitioners, it is easier to use everything based on revenues. So your calculation can give you the possibility to consider everything on one base and add them up as a different percentage or different days, right, to come up with some sort of cash cycle, right? So you do know that the cash cycle can be calculated using days of accounts receivable, days of inventory, and so on. But some people do prefer to use revenues when calculating these elements. So as I was saying, what we are going to try to dive today, right, it's on debt financing, right? So if we remember our last Excel, right, I completely omit the debt financing piece and assume that the company was 100% financed, right? I actually have to tweak a little bit the model to make it work, right, in order to simplify it the way we did it. What we're going to do today is going to drill into what are different types of financing, right? What we should consider as part of the financing, and what are the critical elements we should be looking at when we are trying to model that debt as part of our different exercise, right? So I put a few slides here just to put the course of what we are going to be discussing. To that. I think that works. Okay. So regarding the financing, right, as I was trying to explain, there are different types of debt, right, that we need to consider. They have different characteristics, and each one of them are going to have different issues that we should be aware of and know how to treat them and model them correctly, right? So when we talk about debt, right, I have listed here a few, and we are going to discuss a few others, obviously. We can discuss them in terms of short-term debt and long-term debt. We can also think about secure debt or non-secure debt, mezzanine debt, right? Even further debt trust. We're going to discuss that in a bit. We also can think about how is the interest rate we're going to be paying, right? If it's going to be a fixed rate or if it's going to be a floating rate, right? We also need to think about, hey, is it going to be that this debt is going to be paid along the period, the life period that it's going to have, or are we just going to make one single payment at the end? So I have put here amortizing debt. We're going to discuss how that's happening and what's a balloon debt payment, right? when you have small amounts of payments through the life debt, and then suddenly there's a massive increase in the debt that you're going to be paying. And then there's also bullet payment, which is a zero coupon debt, right, that you're probably familiar with if you have discussed fixed income securities, right? Just one single payment at the end. I have also not considered in this analysis the dimension of where do you get the financing, right? You also know that there's going to be some debt that you can get from banks or financial institutions, cajas, pymes, and so on, right? But there's also going to be some debt that you can get from capital markets, right? When we talk about capital markets, we talk about short-term industries or bonds, right? We're going to discuss the difference between those in a bit. There's also going to be the possibility to discuss if we're just going to be getting the financing locally, right, from our banks or institutions here in Peru, or are we going to be expanding and getting it from abroad? And when we talk abroad, it's not only getting financing by issuing a bond 144A in the markets, right? It's going to be also the possibility of getting the financing from multilateral organizations. And then comes different issues that we're going to be analyzing in a bit. Right? So just quickly over short term and long term, you quickly know that short term is going to be something that is 1 year or less, right? What I wanted to point out is the uses of financing, right? And that's part critical because it's important for our modeling, right? When you have a short-term debt, it's usually a revolving debt. And you know the idea of revolving debt is a debt you do pay and then get a lot more financing, not very set. Get again the same amount or similar amount of financing, right, in order to finance your working capital, right? And when I mean finance the working capital is you do now know, right, that the days of accounts receivable, right, plus the days of inventory are probably going to be higher than the days of accounts payable, right? And what's going to be happening is that you are going to need some financing, right, to cover that gap. So the cash inflow in terms of selling the inventory and collecting the receivables, right, is going to take longer usually than your cash outflow in terms of accounts payable. Or usually that happens. And when I talk about the accounts payable, I not only mean suppliers, where you can maybe negotiate with the suppliers some sort of extended period, but also your employees, right, or paying to SUNAT and any tax authority. So in that sense, right, what I wanted to highlight here is there's going to be a gap, right, between the cash in and cash outflows, right? And what we're going to be trying to do with the short-term debt, right, is just finance that gap over time. That's the main idea of the short-term debt and working with a revolving scheme. Then we also have the long-term debt, right, which is due in more than 1 year, right? That's a norm. We're going to have a current portion of the long-term debt balance sheet, but that's still long-term debt. And it's usually going to have an amortizing schedule, right? That is going to be helping you figure out when are you going to be paying that long-term debt. That's the one that we're going to be modeling in a bit, right? That's the one that we do care more about because the short-term debt is easier to manage, right? And you just assume a certain amount that's going to be holding constant, right? And when we're going to be working it out in our model, it's going to be sometimes, as I'm saying, a constant amount or even a plug, right? Depending on the cash flows that you're going to be finding. If you have, for example, in your model, if you have a negative cash flow and it's a small negative cash flow, then you can cover that with a short-term debt amount as part of our structure. What's going to be happening with the long-term debt is that we're going to be using it for capex or long-term projects, right? And we're going to try to do this a matter of caution, right, and conservative approach when modeling a company financial statement, right? Critical thing that you're going to find out when you analyze these companies that are in financial distress and what's happening currently happening in several small enterprises, right, is that they using short-term debt, which is easier to get, right, to finance long-term projects, right, long-term uh, assets, capex in particular, right? What we're going to be finding out here, right, is that these companies are going to be using the short-term debt, as I'm saying, as the financing, and had a higher interest rate that normally will get with the long-term debt. The short-term debt usually do not have any collateral, right? So that means that the risk is higher for the debt holder. And given the fact that it's short-term, usually you use or turn to some debt holders, right, that have a higher risk perception for your company, charging you a higher amount as part of that structure. What is going to be happening, right, it's that in some cases, even you're going to be ending up with an overdraft, which over here. And that, if you know, if you have figured out the interest rate of an overdraft are significantly higher than normal debt, right? If you're going to an overdraft, is that you are having some trouble with liquidity, and the bank do charge you a higher interest rate, close to 30% or more as part of the structure. Okay, let me separate this into other dimensions, right? So the first other dimension that we're going to be touching base with, right? It's going to be the secure, non-secure debt, right? So usually when you hear about secure debt, immediately you think about some type of mortgage, right? You figure it out, okay, there's going to be a lien, right? There's going to be a mortgage in one of our particular assets, right? A property or a land, a building, right? That we can put in place for the bank to collect, to take ownership and sell it to recover the debt they are giving us, right? But it's becoming more and more common as part of the normal capital structure right now to have as collateral for this type of debt what is called a stream of cash flow, right? A stream of revenue that's going to help repay the debt. The way it usually works, right, is that the bank or the institution that is giving you the financing requests that all payments or revenue that you receive, right, from customers be deposited in a particular account, right? So that way the banks collects all the money for itself, right, charges the amount that you own, and then give you what is left. So let me just quickly do a quick drawing over here, right? What we are going to be thinking about, right, in particular, is we're basically creating here, right, a particular bank account, right, that is going to be receiving everything, right? It's going to be getting all the cash that you have. Let's quickly set this up, right? It's easier to do it with the. Let me think if I can quickly shift to the screen that we have over here. Okay, that's easy, right? So what we are basically saying is there's going to be a particular structure over here. We're going to have a bank account here, right? That's going to be receiving all the assets, all the revenues, all the collections that you have, right, in place, right? So you're going to be getting here. Let me just figure it out very quickly. We are going to be having here receiving all the cash, right, what we are talking about in a bit, right? And then we're going to be getting here all the accounts receivable are being paid here. Sorry, there's a type here. Or the collections, very set, right? That's the word I'm looking for. All the fashion collections, and they actually do charge where what we are saying, they do receive all the interest. So there's some showing up over there. All the interest, right, and principal payments that are required are collected from the account, right? Principal payments, and when they collect themselves, right, that amount that we are saying, when they receive that amount, right, then whatever is left is transferred to the company's account, right? Then we're going to shift this here. Sorry, that is not that good today regarding drawing. Right, so whatever is left is leaving to the company, right? That's a waterfall approach, right, regarding the financing. This is called a waterfall structure that the bank has put in place, right, to receive and collect the money, right, for the company. This is going to be, sorry, 1 minute. This is the company account. I'm trying to write it out. So there's a particular bank account that is being put in place over there. So we have some latecomers. Don't worry about that. So that's how the bank, right, assures themselves that they're going to be capable of collecting, right? So as you realize, this waterfall structure, right, is becoming more and more popular regarding financial institutions and any other lender that you may have, because it assures them that they're going to be receiving the cash, right, up front, instead of getting to collect the money from selling a particular assets if you decide to default. One other element. Okay, that's fine. Yeah, sorry. Let me just switch back. So one other element that usually do appear, but is less frequent here in Peru, right, is the possibility to have several mortgages, right? So when we talk about this in terms of financing, what it means is that you can be offering the bank, right, an asset that has so much value, right, that is 1.5 times the loan that you have, 2 times the loan that you have, or even more, 3 times the loan that you have, right? In particular, if we're talking about a property or a building, right, it is very common that you are going to be ended up offering the bank, right, an asset that is going to be at least 1.5 times the loan that they are giving. That's usually the ratio they request, so 50% more than the asset that the loan that you are getting, right? Because the bank, what it wants is that if they have to take control of the building, right, and try to sell, right, this realization value, this fire sale value, liquidation value of the asset, right, usually has a discount between 20 and 50%, right? So the bank tries to cover themselves for any potential change in the market value of the asset, plus the idea that they are going to be going to try to sell that particular asset. But what I wanted to highlight is that it's very common outside our banking system, right, to have a second claim on the asset, what second mortgage on the asset, right? You probably have heard that in the news, some movies, when they refer to the possibility of getting a second mortgage in some particular houses, right? That's a home mortgage, right? And it was very common in 2002 to 2008, right? That people have second mortgages or even third mortgages in their homes, right? And the reason for that was that there was a bubble in real estate in the United States. Oh, sorry, I mean in the United States, that's what I meant, right? Because there was this real estate bubble in the United States that created an artificial increase in prices. So you have a home, right, that was worth, let's think about $300,000, right? And obviously you get a mortgage on that home, right? And the mortgage is usually for, let's say, $200,000, right? So it's 1.5 ratio. But suddenly the house that was worth 300,000 increases prices to 500,000. So you figure it out right now, the ratio is not 1.5 because it was 300,000 to 200,000. Right now it's 500,000 to 200,000. That's 2.5, right? There's even room for more mortgage, to more financing using the same asset. And there are banks who are willing to get into a second lien and second mortgage and collect after the first bank receives the payment for this loan, right? That's where there's a first claim or second claim for the asset, right? They collect after them. But given the fact that the price of the asset right now is 500,000, the second bank is comfortable to give you, right, some additional amount, let's say 100,000, and raise it to 300,000 total debt, right? So the first bank has 200,000, the second bank has 100,000 in addition to that. That's part of the whole structure on the claims that we have, right? Um, let me, I want you to quickly highlight that structure. It's working. Let me quickly explain that a little better because it was part of the real estate bubble, right? And it's something going to happen also to your financing with your model, right? So what I was saying, there was a first mortgage, right? And we are talking about a house here, but it's going to be the same if we talk about a building in our financing. I mentioned that it was 300,000, right? And there was a first mortgage, right? This is going to be mortgage, or the loan is going to be only 200,000, right? We talk about that. And what I was trying to explain is, okay, let's imagine for a second that the price of the house, right, given the bubble that it was occurring, rises to 500,000. And the first thing you're going to say is, hey, this is an increase of more than 66%. Yes, it did happen in some locations in the United States, right? So given the fact that right now we are 500,000, this ratio that I was claiming of 1.5, right, did not hold anymore, right? Right now, the ratio that we have of the value of the house to the mortgage is 2.5. So you are willing to get a second mortgage, right? And a lot of people finance uh, their expenses that way, and that's the thing that we need to think about when we talk about financing from the business, right? They are using this mortgage on the house to finance their regular expenses, right? Trips, vacations, expenses in cars, right? Issues that are not necessarily generating a stream of cash flow. And it goes directly to the company, right? Imagine that this is a company and it's getting a second mortgage, right, on the building to finance net working capital, right? If they are financing inventory, that's not going to make any sense, right? If you are putting a financing here in the long term, right, you need to try to finance, right, issues that are going to be generating a lot more profit, a lot more cash flows into the future, right? So what I was meant to say is there's going to be another bank willing to give you 100,000, right, for this house, right? And with the second mortgage, the total is going to be this situation, right? It's going to be the 500,000 now, and right, and the value right now is going to be 1.6. It's still over the 1.5 that I was saying, right? So that makes sense for some people to have this structure in general. What was the real estate bubble that occurred, right? You obviously know about it. What actually happened was, and I'm going to copy this down, right? Just make it clear, is that this 500,000 actually dropped, right, to, let's say, 200,000. So in that case, right, some of the banks, in particular the second bank, was not capable of collecting at all. the value that they give, the debt that they give to this particular real estate holders, right? And the same thing can go here, right? So there was a lot of fear here in Peru before COVID-19, right? We were going to start a real estate bubble, right? There was some oversupply in offices, particular Class A offices, right? The most expensive type of offices in general, right? The demand was not covering the supply of offices that was available, right? And that was the bubble that people were expecting to burst and decrease significantly. That was in the office real estate side, and there was fear here that there was going to be another bubble, but in a housing market, right, with some particular prices that were off the chart, right, compared to prior years. What has happened with the COVID-19 as part of that conclusion is that there's no more increase in prices, in particular in the real estate market, but a decrease significantly given this structural change, right, that is happening right now. Let's switch back to what we were discussing a bit. Okay, that was for secure debt. Let me just share that. But for non-secure debt, okay, there it is. For non-secured debt, right, obviously you have a claim over the general net worth of the company, right? There's nothing that prevents or allows you to collect something from the company, right, if it goes bankrupt, if it decides to default your debt, right? Obviously, there's going to be some clauses in the loan agreement that are going to allow you to go to a judge, right, or an arbitrage tribunal that is going to help you basically collect some of the money, right? But that's going to take some due process in order to be capable of receiving the money that you lend to the company in particular, right? The key element that I wanted to highlight when I mentioned non-secure, right, is that it is subordinated to the secure debt. So we're going to discuss this in a bit, right, because there are several levels of subordination within debt, right? It's called prelación in Spanish, right? So we're going to have secure debt as the most highest unsecured debt for the debt holder, and then you have non-secure debt in general. But then we can also talk about trust and mezzanine debt, right? So trust, as you may have heard about, is a particular structure, right, that allows you to segregate some assets or cash flows, right? Future assets, that's what occurs with future cash flows, right? And use them to structure the financing of the company, right? And I wanted to highlight also that it can not only be done through what we call here a trust, un fideicomiso, right? A través de una entidad titulizadora, but it can also be created using what is called a special purpose vehicle. So if you go back to several years ago, a special purpose vehicle became very, very famous in 2000 because an energy company in the United States called Enron used them massively to share with shareholders and other stakeholders that they had a massive amount of debt, right? Special purpose vehicles and structure that you can create, right, to put some assets and issue debt as a counterpart of that particular structure. Let me quickly go back and here and quickly explain the idea, right? You do know part of this, right? As here is this in Excel. I think it's easier in Excel. Let me share that back up. So for me, it's easier in Excel sometimes to put this up, right? So you know that a particular, let's say, company X, right? You particularly know that they're going to be a company with a particular assets and liabilities. Our typical structure has PP&E inventory, right? And PP&E. And what we're going to be having logically is that there's going to be a structure that we can use to issue debt into the market, right? Or in this particular case, it can also be given in a direct loan to some lenders, right? Not necessarily a bond, right? We can actually direct that issuance of debt to a particular lender. And what we're talking about here are family offices, right? People that decide that wealthy people, highly net worth, with high net worth that decide to give money, right? But they require some sort of a structure in order to be more certain that you are going to be repaying them, right? That's why we create this structure called a trust, right? Or a special purpose vehicle, as I was saying, right? And what we're going to be having is that one of the PP&E, one of the assets that are here, right, is going to be used to finance, right, as a collateral, this structure, right? So we're going to be putting here some property, plant, and equipment, right, that is going to be held as a collateral in particular. We are going to be giving this trust, right, the whole ownership and control of these particular assets. And what is going to be having, so it's going to be going on this side, right? It should be on that side. Let me switch this back. An asset should be on the other side. Putting it backward. There we go. Put it on the wrong side. Okay, so we have the PP&E on the correct side right now. And what we are going to be doing is we're going to be issuing, as I'm saying, a bond here, right, or a loan that is going to be giving us the financing, right? So this trust is going to be the structure that we're going to be having, and this is going to be acquired, as I'm saying, by, so the debt holders are going to be here, family offices. Whoa, 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 whoa. I activated an array without meaning. We're going to be having here family offices, as I'm saying. We're going to be having here typical institutional investors, right? And we're going to be having here highly net worthy. So when I talk about institutional investor, I'm missing here a C for a T, right? I'm talking about mutual funds. I'm talking about here even pension funds, insurance companies, and so on. For example, you do know that there is parking station, parking lot underneath Parque Kennedy, right? So that parking lot, it belongs to Los Portales. The way they decided to finance part of their normal operations is they created this trust, right, where they have given, right, as an asset all the future collections, not a PP&E, but for the future collections, all the future cash flows they're going to receive from that particular parking lot. And they issue a bond, right, that has been acquired by different debt holders, right, as a way to get the financing, right? And in this particular case, it's a bond, right, that they have issued in particular 2 years ago as part of the financing that they get. I also mentioned that it can also be a loan, right? It can also be a direct loan, right? Not a bond structure, but it's very similar in general. But it's going to have some particular characteristics depending on the debt holder that we're going to be considering as a part of that. Okay, so coming back to our jumping. Okay, so here we are. So that's going to be a structure that we were talking about trust. But I wanted to mention the other one that is also a non-secure, right, which is called the mezzanine debt. So if you want to think about related subordination, right, you have the secure debt, you have the trust, right, You then have the non-secured debt, and below them you have the mezzanine debt. And the mezzanine debt, right, is usually a subordinated debt that has a particular characteristic. It has the option to convert that debt to equity, right? So you can transform the debt that you have, particular company, to shares of that particular entity. And the idea to do that, right, is that you are willing to give money on a risky project, right? Um, for example, for startups, it's very common to receive this type of structure, this type of debt. They do get charged a higher interest rate because of the risk, but the debt holders have the possibility of becoming a shareholders into the company, getting all the benefits from that equity increase, right? And that has occurred over time if the startup turned out to be a success. So once again, these mezzanine debts are usually present in high-risk projects, in high-risk companies, as a way to bypass the typical problem that they do not have a very stable stream of cash flows, right? And then they need to get the financing, and the debt holders are willing to do so, right? Are willing to put money into the company, some form of capital, but they decide to not invest in terms of equity at the beginning, but decide to give them debt, right? So they collect before the usual shareholders. And then if something goes well, if everything goes well, right, what is going to happen is they are transformed themselves to shareholders as a whole, in general. Okay, let me switch quickly to our Excel, the first Excel that I posted. Let me switch this back over here. What I'm showing you, right, and I wanted to highlight first, is the information that the Superintendencia de Mercado de Valores has available on one of its monthly reports regarding the different issuance of fixed income securities, right, in Peru. This is the information for 2019 because, as you will expect, for 2020 they have not been many issuance regarding fixed income, particular given the current situation that occurred and the quarantine period that affected the issuance, right? Just in case, this information is available right over here, right? If you want to check it out, orientación, and there's an option here regarding statistics and publication, and that's the monthly report, right? So you get this data in general from there. Let me just hold this for a minute. Let's change the mobility. You know that is December, right? We're going to be quickly going over a few of these just to highlight and explain some of the issues that you have over here, right? Um, when you see these short-term instruments, right, that is going to be happening, instrumento de corto plazo, that's a typical one. You obviously know that it's less than 1 year. Certificado de depósito negociable is an instrument that is normally issued that is issued only by financial institutions, right? And it's usually short term, right? That you're going to be seeing. In those cases, you're going to find out that they're using a single deal, right? That reflects what is the return that you are going to be receiving, right? This is that if you purchase or acquire these particular financial instruments, right? So there's going to be one single number that you receive usually at the end as part of that structure, right? The other thing that it's present here, right, when we are going to be analyzing this is the possibility that it's longer than 1 year and you get a tasa interés nominal anual. We're going to touch base on that in a bit, of how that is the norm that we transform this tasa interés nominal anual into tasa efectiva anual, right? Effective interest rate. That's the most common way we are accustomed to talk about regarding financing, right? It's usually you're going to see in the case of bonds, right, that they normally have a semi-annual payment, right? Payment every 6 months, that's the norm. And obviously this interest rate, right, it gets transformed from a semi-annual capitalization rate or compounded interest rate, right, with semi-annual payments to an effective annual interest rate, right? But there can also be other bonds, as we're going to see in one of our examples, that it can be monthly, right, or quarterly, 3 months in general as part of that. Um, there's, well, obviously in these particular cases, there's the distinction in currencies, right? Because you can issue them in dollar or in soles. We are one of the few countries in Latin America that uses two currencies in our capital market as a whole. And there's this other element that I wanted to highlight, right? Which is valor actualización constante plus a margin or spread, right? So valor actualización constante, it's a legacy from prior decades where inflation was very important. Here in Peru, we had two-digit inflations, right, as part of our normal business. What happened was that people get accustomed or or investors get also interested in this type of asset because it assures them to receive a real interest rate, right, according to their expectations. So in this case, this valor actualización constante is updated, right, every time this corporate bond pays, right, and basically you're going to receive the inflation rate plus 3.4625% as the interest rate that you are going to be collecting from the company, in this case Interbank, as part of their investment, right? That's basically the typical way. It is less and less common, right? Here in the whole 2019, there were only two of them being issued, right? As part of their financing, but it becomes more and more common to use a fixed rate normally for bonds as part of a structure, given the fact that inflation is not that material, or at least it can be forecasted correctly, right? The expectation of inflation do not change significantly from the moment that the bond is issued to the later years as a whole. Okay, so let me switch back to the other file that we have on hand, right? And I have put a bonus schedule over here, and let me mix it up. Here it is. Okay. I put here a bonus schedule, right, along with a fixed rate and along with a floating rate. And we're going to touch base in each one of these elements as a whole. This bonus schedule that I have highlighted, right, I have assumed a monthly payment. I mean, you have this also on Blackboard Learn, right? I have decided to use a structure that explain it step by step, right? But several people omit these columns that I have put, such as date, right? Because it's just a difference between end and start date, right? And I'm using the payment date just as a reference in general, as we are going to be realizing. Normally, the end date and payment date try to coincide, right? Try to be the same one, right? But there are, depending on contract, right? Depending on the bond prospect that has been given to the investor, right? That it can be the case that the end date is a fixed one and the payment date is just the next business day as a whole. I am using a reference rate that is 0 because we're going to be using that for the floating rate. It's a structure that I try to use in general. And there's going to be a margin, right? In a particular case, we have assumed a 10%, right, for this bond that I mixed it up, put in the currency, right? The currency here is going to be soles, right? That we're going to be using in general. I have assumed my initial amount, right, and some initial interest payment, right, and some amortization. And we're going to pray along with the amortization to just exemplify what we have been talking about, right? And as you can realize, one of the key elements that usually occur with finance is that there is a grace period, right? In this particular case, there were 6 periods, 6 months, right, that was given as grace that imply no amortization, not principal repayment, right, as part of that schedule. You still have to pay the interest, right, but you do not have to repay any part of the principal. And the other element that occurs here in Peru, right, that, and I wanted to highlight that, is that the interest rate, right, it's tasa efectiva anual. I'm going to do in a minute what happened bond in the US, right, to make this more evident. So if when you have a tasa efectiva anual, right, when we have a TEA, let me highlight that first, right? What are the key characteristics that you need to figure out is, okay, what is the capitalization period and what is the base that we're going to be using, right? We're going to be using here actual over 365, right? As it appears formula that you can see. But what other alternative you have, you can also have by actual over 360, right? And that basically depends on the bond contract, right? Less and less common is trade over 360 as part of the structure that you will be having in this particular setting, right? So what we are having here, as I'm saying, is this calculation using tasa efectiva anual as part of the structure, and I'm using actual over 365, as I was mentioning, as part of the calculation here. That's nothing new on the formula, as you can realize, just applying that same formula to the initial amount, and after the first amortization reduction on principal, you apply to what is left, right? There's nothing complicated on that. Let me explain quickly what happens with the bond in the US, right? Or if you get financing from abroad. Let me switch the currency to dollars just to make consistent that this happen with things outside, right? What normally occurs outside Peru is that you do not use tasa efectiva anual, effective annual interest rate, right? You use nominal interest rate, right? So this interest rate that appears over here is going to be divided by 360, right? Times the number of days times the initial amount. So when you talk about nominal interest rate, right? Or better said, simple interest rate, because it's not compounded, right? You still need to define the base, right? The base that is being used here is actual over 360. Let me highlight this one, which is the one that I'm using, and take the ball from this one, right? Down. And you obviously are realizing that compared to the tasa efectiva anual, right, the simple rate charges you a higher amount, right? The way it's structured, when you convert this interest rate of 10% using the compounded formula, right, it's gonna give you a lower amount in the compounded than just using the simple way, as it usually happens with the formula. What else in here? And the reason for that, by the way, that we are one of few countries, right, that's still using tasa efectiva anual, right, in some of our structures for bonds or loans, right? Is because back in the 90s, and I'm talking finishing the 80s, initial of the 90s, right? there was a lot of confusion, or there was a lot of confusion created by financial institutions offering interest rates and nominal interest rates with different capitalization, right? So imagine somebody offering a 10% interest rate, but with monthly capitalization. And then somebody else offering you an 11% interest rate, but using daily capitalization, right? Given that there were so many different capitalizations, people were baffled, were not capable of understanding how to compare interest rates, right? So one of the idea of the regulators, Superintendencia de Bancos y Seguros and Banco Central de Reserva, was everything is presented annual effective interest rate as part of the structure. And that's the reason why we are using that here in Peru as an audited compared to other countries in general, right? Most countries use nominal interest rate, and that's the way they normally operate in general. Well, you can play around with the bond, as I was saying, right? Let me jump quickly to the loan, right? And you're gonna realize it's very similar in structure, right? If we talk about a loan that has monthly payments, you are gonna observe some particular characteristics in general. And one of the issues that I wanted to highlight, right, is usually the mathematics that go behind the loan, right? You probably know, obviously, about the annuity discount factors and so on, right? And we're going to apply them here, right? So here in this particular loan, as I was mentioning, it's going to have the same structure and same characteristic as we were saying as the bond, right? Still, you're going to have to figure it out that this is there, and obviously you need to figure it out that this is actual over 365, right? That's going to be the base that is going to be used upon, right? But what we are going to discuss right now is, okay, how is the amortization affecting us, right, in general in this scheme? So here I have put just a few numbers, right, to come up with the total amortization that we are having. But it is very likely, right, that you are going to have in loans, right, a structure that is going to give you a single coupon, right? You're going to be getting a single coupon in general as part of the typical structure that we're going to be having. Right, so we are going to be getting these interest payments over here, right? And we are going to be trying to find, okay, what's going to be the single coupon that we're going to need, right, in order to arrive to the amortization that is going to be happening. Let me just increase here and put a coupon over here, right, which is the amount that we're going to be paying, right? And you usually also see this in bonds, right, as part of the typical structure that we're going to be having. I put the numbers, give them randomly, but they are very close to a single coupon, but not quite, right? And you know that normally you figure this out with your annuity discount factor, right? To come out what is the amount that you should receive in order to collect the 10% that we are discussing here, right? So you do know that we have TEA in this case, right, at an effective interest rate of 10%, right, we're going to have some certain number of periods, right? In this particular case, you need to think out of the periods after the grace period, right? So we are talking about this number, we are talking about 66 periods in general, and we are figuring out, okay, what is the annuity discount factor, right, that is going to allow me to figure out the coupon here. If you are obviously working bank, right, this is usually prepared by the banking system itself, right, with some minor adjustments, usually for insurance and usually for the payment date. I'm going to assume that the payment date is constant, right, and we quickly can figure this out without any trouble. So we are going to be calculating, well, the annuity discount factor in here. I need to transform that annual interest rate, right, to a monthly interest rate. That's fairly easy for everybody, right? We just put that to the power of 12 minus 1. So the 10% interest rate, right, becomes a 0.8 annual interest rate, right, and we go with the typical. Wait 1 minute, I'm just getting confused with the formula in my head with the unlevering formula, which I was reviewing the beta of assets a while ago with your friends from financial research, right? Okay, here we go. 1 minus 1 plus a divided to the power of, hope I make it step 65, missing one parenthesis, right, divided by this rate. Okay, so that's the ADF to bring everything to the present, right? And you need to transform that into 1 divided by ADF, right, in order to come out with the coupon, right? What we're going to be getting is here the principal is, and then the coupon. You all fairly know this from your classes. Please tell me if you are missing somebody in part of this structure, right? 74 times 180. Let's check that. Number does match some of my first, but I think and the amortization just becomes obviously the difference between the coupon and the interest, right? You do know this part of that structure. There's a typo here. If I make a mistake, it's 360. Oh yeah, I know what's happening. What's happening? It's the actual over 360 what's passing everything. Let me just quickly go here. If something like this happens, right, when you are trying to structure it, it can be, first of all, the issue of the 365 that I'm using, right? So normally when you have been analyzing bonds and loans, right, it's actually over 360, and then the typical ADF formula is going to work, right? Right now it's not working, as you realize, because if I'm use that coupon, right, I end up with a negative amount. That's not going to be helpful. What is happening is my interest rate, right, is using actual over 360. When you have been doing your typical uh, evaluation of bonds, right, you have been using actual, no, sorry, you have been using the base of 30 over 360, assuming everything is 12 months, right? So Fortune Excel, right, that's allow us to simplify this problem with goal seek, right? What we basically do is we assume a coupon, right, that I'm gonna, and using this is still good because it allows you to get close to the number, right? I'm putting this as a number, and I'm gonna be linking to this amount, right? And obviously, what we are gonna be doing is linking everything to this cell, right? And we are gonna be using GoalSeek to calculate what's gonna be the coupon that allow us to figure it out, right? It can also be worked out with the math, trying to come out with the actual over 365, right? The problem being that the days that we have are changing over time, right? So it's not going to be that easy to solve it out as you normally will. But the good thing, as I'm saying, is that this structure that we have over here does allow me to quickly come up with the correct coupon at all, right? And why doing this, or why are we building this out, right? what is it going to help us with the modeling? Well, from a financial standpoint, obviously, if you are the CFO, right, if you are analyzing your company financing, obviously you want to have your schedule evaluated or questioning what the bank is giving you or the other lender are giving you, right? That's for one. But what we are going to be doing later on, right, is we're going to be using all these amortizations, right, all these reductions that we have on the principal, right, as cash outflow, along with the interest payment. That's going to be useful when you are going to be forecasting, right, this information for the next 5 years, right? Realize that this goes from end of 2020 to beginning of 2026, right? So that's why I wanted to have this set it up correctly, right? So this is loan fixed with, let me put it here, with coupon, right? Any questions so far on what I'm doing, what I'm trying to do over here? As you some of you have been experimenting with schedules, right? The only critical thing that you probably have not observed is this issue with the bases, right? It actually throws a lot of people away from the typical calculation. And some of the formulas in Excel have these bases embedded, right? For example, when you try to calculate a coupon using the end period formula that is in Excel, it uses 365, right, as the base. And if you are working with a loan or a bond with actual 360, right, as it appears over here, right, or it will actually give you a different coupon, and it's not going to be a correct one as part of the typical calculation. What I wanted to highlight right now, let me just quickly shift over here, is that, let me change this. I know, give me 1 second. There we go. What we are going to be doing is that just to exemplify what I mentioned before, right? Just to exemplify what I was saying before, there are different type of loans regarding amortization, right? And that's going to be impacting the duration, right, of the bond or of the loan. The duration means the average life of the bond or the loan, right? Or or better said, the sensitivity that you are going to have, right, to a change in interest rates regarding your investment in, right, in particular. What we are going to be having, what I was mentioning before, is that there are other types of loans with different amortization schedules, not only coupons, right? You can have what I mentioned, that is a zero amortization until the end, right? That's what just at the end in general. It can also be a typical amortization, such as it was 66, right? That you divide this over time, right? And you just paid it until the end, right? Just a typical amortization that is streamlined. Or it may be a bullet one. And when I mention a bullet one, and let me give you an idea what's happening right now, 120, let me put that. And what occurs here is that in the last year, for example, it explodes, it's increased significantly, right? So this is going to be this divided by 12. You realize that you have been amortizing at 31,640, and suddenly it jumps to 174 at the end, right? This has been increasingly used by banks, right, to give customers the possibility of getting long-term financing um, and getting some additional liquidity at the beginning. So for example, that you are a company, right? And you go through your typical coupon analysis, right? You are the CFO of the company and figure out, hey, given the number of the interest rate, right, and the amount that I need to finance, right, I actually need this to be 100, no, let me put 24, 64, 24, 90. I'm going to need some two years in addition to this, right? Not only 5 years, but give me 7 or 8 years in total, right? That means the coupon decreased from 74, right, to 59,000 as part of the normal operation that you're going to be having, and that allows you to have enough liquidity at the beginning, right? But the bank is unwilling to give you 7 years. 7 years is too much for the bank, right? Normally, the banks loan you between 3 to 5 years, right? If you need a longer period of time, it will require a capital market scheme, right, such as a bond that we have been talking about, right? The bank normally loans more than 5 years only to project finance infrastructure projects, right, as part of their facility that they have. So once again, you need the 59 that we are talking about, right? Or even closer, right? As we're saying here, let me just put that to 90. Am I correct? Yes. Oh, yeah, sorry, I'm making a mistake over there. Saying it was up to me. Yeah, there we go. I've managed to get the 59. So if you need the 59, right, what the bank's going to do is, okay, let's discount significantly the first amortizations, right? And you're going to be paying close to 59. But once you get to the 5-year mark, right, then it skyrockets, right, in order to finalize repayment, not in 7 years, but in 5 years, right? That's the way they normally structure it to work. You realize that it's been down from 59 or 45,000 to 200,000, right? What the bank is expecting is that you refinance this at this point, right? Or getting another loan in order to continue in business with them. That's the part that they are structuring in general. So that's a balloon, right? This one I'm showing, it's a balloon, a payment as part of that structure. And by the way, this also occurred in the real estate bubble in the US, right? There were customers who were used to paying a coupon that it was very low, right? And that occurred for the first 2 years. And suddenly they ended up paying a massive coupon, right? That actually ended up with them giving the house to the banks, right? For not being capable of paying. Okay, let me jump to the other side, right? In discussing the floating rate, which is a different type of financing. So floating rates are fairly common from banks outside Peru, right? You are not going to observe them here, although there was some attempt to come up with a floating rate only for Peru, what's called Peribor. Peribor, yes, that was the name was called at some point. You probably have heard about the LIBOR rate, right? So the LIBOR rate, it's a rate that is established by financial institutions in London, right? It's basically the rate they lend one another, right? That they give money to one another overnight, only for one day, right? So they basically do survey to the financial institutions and picking up a sample of them to figure out what is the overdraft interest rate that they are charging to each other, right, for just one day. And that's the LIBOR rate that we are considering, right, in general. Uh, but it can also be, and the most common one, right, it's what is the rate that they're going to give to each other, right, for 3 months period. And let me just show you what is available in the San Luis. So the most common one, there we go. This is the Fred San Luis, the Federal Reserve in San Luis, right? And this is a part of economic research. You do know that the Federal Reserve in the US is divided in several regions, right? There's the New York, there's the San Luis, right? There's the one from Dallas, right? There are several regions along the way, right? And each one of them has a representative in the Federal Reserve Board, right? And those are the ones who define the Federal Reserve rate, that is the overdraft rate that you can get from the Federal Reserve for the US Treasury. This is a different one, as I was mentioning, is the London Interbank Offer Rate between financial institutions. And this is the rate that then lend money to each other for 3 months, right? This is the most common one that has been used in order to define floating rates. What's normally used is that you apply a markup, a margin, a spread on top of this LIBOR rate, right, to define the interest rate for your bond or for your loan, right? Most bonds have fixed rates, so this is most typically used in the loan market. What has been happening over time, and this is going back 4 years, right? As you can observe, the London rate 5 years ago, actually, October 5th, was 0.32%, right? It jumped and it skyrocketed to a massive number of 2.8%, right? This was the period that was after the downturn that the global economy had in 2012 to 2015, right? And they recovered it with increases in interest rate, and it jumped to 2.8. Then it started decreasing given the current economic conditions that were happening in Europe, China, and also the United States. And obviously, what you are observing, right, in the past months, it's a volatility that is obviously related to the quarantine and COVID, right? The low number that we are observing right now, 0.24, right, was, sorry, 1 minute, let me shut that down. Sorry for that, I need to close that door. So coming back, what I was saying is that the volatility that you observed was for the quarantine, and also the current economic conditions warrant a LIBOR that is very low. You probably have heard about LIBOR also from the news because there was a LIBOR scandal, right? What you are gonna obviously figure it out is that these are rates that are calculated from information from the banks or defined by the banks, right? And who would imagine these guys decided to make a collusion and try to manipulate the numbers, right? So figure out that this is the offer rate, right? It's not the rate that they traded, that they actually traded, right? They just give the information to each other about how much is going to be the amount that they're going to charge. And what's obviously occurred is that they started to make offers that actually deviated the LIBOR from its normal market value, right? And the reason they did that is that this LIBOR rate is also used to value financial instruments, right? Such as bonds, in particular derivatives, right? So when you manipulate the LIBOR, you are capable of obtaining mark-to-market increases in derivatives, right? And that imply for the treasuries of these banks an income that was rated. Obviously it's accounting, right? It's not that they actually executed the derivative, the forward or the future, It's an accounting return, but in that sense, it actually created an increase, right, in profits for some financial institution. It's obviously manipulation that was founded, that was found, sorry, by the regulators, and actually, while they were severely fined. And one of the instances that is going to happen in the coming years is that this LIBOR rate is going to be replaced by some other rates that are being prepared by regulators and exchange commissions, right, such as the SEC, right, and the New York Stock Exchange as a whole. That's what is probably going to happen at the end of 2021 that we are going to be observing. But right now, as I was mentioning, several loans rely on this rate, right? And what occurs in our case, right, is that these loans that we have over here, right, are going to be having a floating rate with an interest rate, let me just correct that, that is being calculated, right, as a sum of the reference rates plus the margin. So I have assumed a 9%. This is the LIBOR rate that is currently, as of yesterday, right, if I recall correctly, 0.21788. And this LIBOR rate, right, it's for 1 month, if I recall correctly, right? Because these are monthly payments. So you're going to have to put the LIBOR rate that is consistent with the period that their interest payment is going to happen, right? And we're going to be having here the sum of these, and this interest, sorry, it appears to be copying the wrong formula, should be the interest rate times divided by 360 times the number of days times the initial amount, right? And the issue that is happening here is when you have floating rates, right? What is obviously going to occur is that the interest payment is going to be resetting the interest rate after every interest payment, right? So let's assume that we are here in 17th of March 2020, right? And let's think about that. That was the LIBOR in March, right? What is going to occur in April is that you are going to be facing a different LIBOR, right? Changing it completely for the interest payment that is going to occur on the 17th, 18th of May, right? And the 18th of May, you're going to have another LIBOR rate, right? That it changes and it can go up and down, and it actually depends on that, basically, as part of the whole exercise that we're making here, right? We are going to be observing this all along, right, in all the different periods that we are analyzing. What I wanted to highlight, and the question that is usually brought, let me just show the LIBOR once again, is why somebody will decide to go with this structure, right, that has so much variability in terms of getting the financing, right? Why not opt to the SAIFLI number, right, that you can get, and that eliminates the uncertainty about how much you're going to be paying? Clear, there's an issue here that we need to address, right? Which is the fact, sorry, it jumps on the other side, that this rate, as you observe, has been increasing over time, right? But logically, the interest rate that is being charged in this particular case, it's lower than the one that I assume in the fixed, right? So what normally happens is the banks, right, are gonna consider, keeps jumping to the wrong side, let me just put it back here, are gonna consider that, okay, the interest rate here is low, right, but I expect it to go back up. So it's more important for the bank, or the bank has the idea that they are capable of charging a LIBOR rate, a floating rate, because they expecting it to increase. But they also consider, okay, if that is the case, right, if the LIBOR is going to increase, then my fixed rate has to be some way around here, right, in order to incorporate that expected increase in the rate. So that's why the banks, what normally will happen is they're going to charge you a fixed rate, right, that is higher than the LIBOR if they are expecting that is higher than the floating rate with the LIBOR if they are expecting that LIBOR will rise. That's part of the norm that they have. So it will be sometimes better for you to opt for a floating rate, right? And continue to mark up the market and figure it out if it makes sense to continue in this stream, as long as you have lower LIBOR rates, right, that are not increasing significantly, right? Normally what will happen if the LIBOR rate rises to an amount that it's above what you will normally charge, right? And despite the spread that you have, is that the bank, sorry, the company will repay to the bank the loan because they are being overcharged. So let me explain that back up because I think I misspelled several words, right? And let me switch to quickly to Spanish to make it more clear. La razón por la cual existe esta deuda flotante o tasa de interés flotante, mejor dicho, es porque yo como empresa puedo tener la idea de que mi tasa de interés a tasa LIBOR más un margen, asuma que hay una línea paralela lógicamente acá, más un margen, resulta siendo más ventajoso que tomar una tasa fija del banco. ¿Por qué? Porque el banco lo que va a optar es a fijarme una tasa, supongamos en 2.5, que es la tasa fija que considera el interés que va a ganar asumiendo que la LIBOR va a subir en el tiempo. ¿Qué es lo que va a pasar? Si la LIBOR llega a subir en el tiempo de forma tal que, pongamos este punto, el más un margen, o sea, pongamos en 3%, ya estoy por encima de lo que el banco me cobraría tasa fija, decidiría cobrar tasa fija, la entidad, la empresa en este caso, opta por prepagar la deuda, y eso lo podemos modelar también, y básicamente engancharse ahora a la tasa fija como parte del financiamiento. Esa es parte de la estructura que normalmente manejamos. Y dado el contexto actual que estamos teniendo en tasas de interés LIBOR bajas, se observa más en el mercado de préstamos en el exterior tasas de interés flotantes. Specifically, if we want to think about this, right, you do not have to go outside Peru, right, to get this type of financing. Several banks in Peru, right, do give you this floating interest rate, but they did that using their desk in New York, right? Scotiabank has a desk in New York, has a New York office, and the New York office is the one giving you the loan, or the Miami office, right? And even though they do not have a banking office, let me explain, set that back. Even though there are some financial institutions outside Peru that do not have banking authorization and banking branches here in Peru, they are companies that receive loans from Credit Suisse, Bank of America, Merrill Lynch. You also have JP Morgan, Morgan Stanley, and so on, right? There are Peruvian companies that can get those loans from outside Peru, right? And with this floating rate that I mentioned as a whole. That's normally usually for corporate companies, right? Not for small enterprises, but it's something that do happen as part of the structure. Okay. So let me go into the fixed side, and this is the coupon. Yes, this works. Let me do, time is running out of initial structure. something different that you probably have heard about. So you have heard about payment in kind, which is PIK, right? As part of the way a company can pay a loan, particularly if they are in liquidity shortage, right? Payment in kind is nothing more than capitalización de intereses, right? And payment in kind is a structure that we're going to look when we work it out the model a little bit further about how it has an impact, right, on cash flows and tax shields, right? So what payment in kind assumes, right, is that okay, we're going to have an interest payment, and I'm assuming here that we are in TEA, but it can also apply to simple interest rate, right, or even with the floating rate as a whole. I just use the fixed for simplicity purpose. What it implies is that you are gonna be increasing, right, the amount that you are owing to your debt holders as part of the structure in certain period of time, right? Usually the payment in kind is for 6 months or even a year, no more than that, depending on the liquidity shortage that you have, right? So I'm going to put here payment in kind, right? And I'm going to save this, by the way, into Blackboard Learn at the end, just in case you're not following. And I'm going to keep here the interest, right? But this is going to be important for accounting. These are accrued interest, not paid. It's not a cash outflow, right? It's not the payment. Let me probably made the mistake of putting it to the right of coupon. It actually makes more sense to put it to the left. And what we are going to be seeing is, okay, we are going to be accruing these interests, right? And I'm going to assume that they are capitalized as part of the structure. So what you are going to be observing is that we convert this formula to an increase, right, in these elements. And I'm going to copy the formula below. You observe what is going to be happening. Finalize here. Here, the separation between interests, right? These are paid outflow. They are capitalized for the first 6 months, right? Increasing the principal payment to 3,983,000, right? And then we start actually repaying the loan. So let me put here for the coupon. The coupon here is the interest paid plus the amortization, right? And that goes all the way. So it's going to be zero payment for the company, right, in the first 6 months that we are going to be having, right? And we are going to be here signaling that that allows the company to get a lot more liquidity in the first 6 months, right? The grace period not only becomes a grace period for the amortization, but also for the interest payment, right? And then you start repaying the total amount of the loan that we are going to be having, right? And I have assumed here still with the balloon payment, right, arriving to zero in general as part of that. What this implies that we should be aware of that I was mentioning is, okay, how is this going to be helpful for us when we are going to be modeling, right? The free cash flows, for instance, and all our analysis. So just to finally, right? For the income statement, obviously you still need to consider the interest that is accrued, right? So you still have that as an expense. It's a financial expense, remember, right? You're still gonna have that as a financial expense in your income statement, right? And dropping it this way because if we manage to put it sum if for the years, right, we can consider all the interest payment that we have. So we have this, as I was saying, for the income statement. That's going to be an expense, right? What else happens, right? Obviously, since it's in an expense, right, it's generated a tax shield, an interest tax shield. We're going to have to consider that this interest that appear over here in the expense generates an interest tax shield. So if you are using the adjusted present value methodology, right, it allows you to correctly calculate the interest tax shield you're going to be having, right? It's still going to be expense over here in general. But what it will not occur is that it will not be in the statement of cash flows, right? It will not be appearing in the statement of cash flows up until this point. This is where it's going to have occurred. And why is this important? Why do we care about the statement of cash flows in general, right? Well, obviously we need to forecast it to complete the three financial statements that we're going to be doing after the midterm, right? But what I wanted to highlight is that when you analyze cash flow forecasting, right, what we're going to figure it out is, okay, in order to be capable of solving our repayment of debt or other additional financing, we are going to need to figure it out how much interest payment we have in total, right? Explain it better. Cuando vayan a calcular la deuda, cuando vayamos a calcular el modelo de balance general y determinar cuánto es la deuda revolvente y cuánto es la caja que tenemos, ¿sí? El dato del interés pagado termina siendo relevante para determinar si podemos repagar la deuda en los plazos que tenemos establecidos, en los montos establecidos y cuánta caja nos queda, ¿sí? Entonces, en estos periodos, que va a ser cero, resulta más relevante para la definición de la caja los datos que vamos a tener del Statement of Cash Flow, del análisis que vamos a hacer. El Income Statement nos va a servir para determinar el Net Income y el Interest Tax Shield va a salir de este expense de los interest accrued. Todavía existe un Interest Tax Shield, ¿sí? Que básicamente se genera al momento que estamos devengando esos intereses en el income statement. Y es acá no he puesto, pero obviamente si es 29.5%, as in Peru, right, normally happens, we are going to be having this interest payment. So let me just wrap it up with a Q2 analysis, right? I have here prepared in different lines, right? But normally, this is type of, I put and C instead. This amortization, right? What we are going to be doing is a schedule of all these different type of debts, right? As part of our analysis. Let me just highlight this here. Right. So what we are going to be working out, right, is to have different schedules for each one of our debts, and we are going to be bringing them to a structure, right, similar to the one that we have been working on before. So if we want to figure it out, okay, for 2021, 2022, and so on, right, the different payments that we're going to be having using these schedules that we have in each one of the different tabs would quickly allow us to figure that out rapidly, right? That's why I wanted to present the different schedules that we have over here. And let me just go 5 years in the future, right? And let's assume we're going to be having here, sorry, 1 minute, it just froze it completely. Finally, give me 1 minute. I'm going to continue with the bond, right? The long fixed coupon. I'm going to assume that each one of them is a different loan, right? And we can discuss later on what's going to be the subordination, right? And figure it out, okay, if which one loans we are going to be paying first and which loans are going to be paying second, right? But first of all, we need to figure out what are the principal payments, right? And what are the interest payments that we are going to be having from each one of these loans that we are going to create, right? Okay, so for the principal payments, this is for this, as we were saying, we just make a summation, right, based on the date that we are going to be having. I'm not using bond US because that was assumed to be in dollars, right? And we are going to be using here the whole payment date, right, as the period. I'm going to be picking up the criteria, which is going to be, oh, sorry, I'm accustomed to my other computer. And then we are going to be summing here on, I'm talking about principal payments, right? So I have used here different types of columns. Usually we will prefer to use, let's go C4, let me just quickly put the 4 here. Let me see if it's having a trouble summing. Yes, trouble summing. So remember I told you that I usually keep a row over a column or a row over here to make this work, right? What is happening is it's not reading correctly the year. So it helps to have these columns over here to help you overcome these issues. So there's a question over here. Sorry, looking at the moderator. Yes, that's exactly what you are suggesting, all I'm saying. I Other possibility, by the way, is using a table, and it actually works well too, right? And it works. Thanks, Paula. Exactly what you suggested. Let me just do this. Lower here, right there. And now that we have it hard coded accordingly, we just can copy it down, right? And I was mentioning that I usually try to have, as we discussed in the first class, to have everything in the same columns, right? Right now we have been adding stuff, but here is still K, still K. Okay, it works. So it's perfect. I didn't change it that much because it allows us to quickly do this, right? You can quickly here go here, replace, and we told them to replace bond, right, with the word loan coupon, right? Oops. Okay, I probably made a mistake here. Loan fixed coupon. Oh, I made a mistake and using the wrong one. Okay, that's not matter about it. I'm just gonna type it out over there. It's not that I'm gonna be doing a lot of this, right? It's just one and it copies to the left. It's not gonna be. Why is not? It should be. Oh, well, I didn't realize what's happening. Let me quickly sort it out. It's this one, right? I'm just not doing this properly. But to put it out over here, right? And it works. Work right now. Let me just. I'm gonna repeat the process just in case it's not gonna be helping me at all. For dot. Sorry, I keep using semicolon because it's gonna be in the K, right? Should be working. Yes, it works. So similar than that, right? I'm not gonna take all the time just to do this. I'm gonna finish it and put it out online on our website just for everybody to follow. But we're gonna do the same quickly with the interest payments, right? I'm actually running out of time of what I wanted to highlight over here regarding these calculations, right? We're going to do the same for bone. What's happening? There was a typo here. Loan fixed, right? And loan floating, the one that we have over here in general, right? And I'm going to put this online just in case. There's recommendation from the REA, right, that is asking me to remind you to fill it out, the survey that has been. So Renato, sorry, let me stop you here for a second and just continue filling out, but while everybody fills the survey, that's probably the best way to go, right? But this is the link. Yes, yeah, finally I figured it out. This is what you need me to do, right? So for everybody, please fill out the survey for the course. I assume it's this one. Let me see if the link works. Gracias.
Profesor, ese es el link. Y esos son los datos que pueden llenar.
How are we doing? Yeah, it works. It works for everybody, right? So let me quickly solve it out this as part of our calculations I was mentioning. This is loan fixed, and here's loan floating. And loan floating. It works. Now it works. It was missing one apostrophe. I just realized that, and the other formula wasn't working out. Yes, this has to have the same one as the above because I assume the same in terms of the structure. And last but not least, I'm gonna copy it down, right? What I'm gonna do is I'm gonna just change the K, right? This is for the principal payments, right? We're gonna go with the interest that is in each one of them is in the J column. Let me just quickly check it out, right? That's why I like to use a single scheme, right, of schedule. Even though for the bond or the fixed coupon, you do not need the reference rate, I like to keep it there just because here it's gonna help me put everything on the K column, right? The one that should be adding, the J column, the one that should be adding for interest, and the K column that should be adding for principal, right? So this is fairly easy actually. We're gonna replace there all the K with all the J's. because silly me, I told them to go all the way, and it also replaced the ones that were on top, and do that. There we go, right? So you got the principal payments and the interest payment, right, working up from the different schedules that you may have. I like to do it one tap, one loan, right? But obviously, if you have several numbers of loans and you prefer to work them out in one single sheet, right, as part of the structure, what I will urge you to do, if you're going to do that, do it to the right, right? Put all the different loans to the right, never below, right? Never put them below, because then you make a on this schedule that you would like to incorporate, and you're affecting the other schedules at all completely. It's better to have them structured. But I do prefer this scheme, right? Because it allows us to quickly capture, right, all the information from the financing, the debt financing of the company this way in general. Okay, so there weren't many questions at all. I assume some of you already know this, but I assume you were not that familiar with the capitalization of interest, and we are going to, and the analysis that how that's going to impact, right, in general. This, by the way, is becoming a lot popular these days, right? Because several companies are in liquidity shortage, and what normally financial institutions are doing is they are capitalizing all the interest past due, all the interest that are accrued but not paid by the companies, and creating a new loan, right? That's part of the structure. All I'm saying is that it's also possible to basically consider that all interest payments are capitalized, and that's gonna be a scheme that works correctly for our analysis in terms of forecasting the debt of a company. Okay, let's wrap it up over here, and let me just put this on top, the financing. Usually use rev as a way to put it. And let's wrap it up for today. Have a good midterm week. Midterm week completely next week. Espero que les vaya bien en los parciales y nos vemos después de 2 semanas.